Chapter 4. Financial Markets and Instruments. Page. Functions of financial markets. Meaning of financial markets. A financial market is referred to space where selling and buying of financial assets and securities takes place. It serves as an agent HW the investors and call for by mobilizing capital BW them. The functions of financial markets are 1. Price determination. 2. Funds determination. 3. Liquidity. 4. Risk sharing. 5. Phasey access. 6. Reduction in transaction costs. 7. Capital formation. 1. Price determination. The financial market performs the function of price discovery of the different financial instruments traded BW the buyers and the sellers on the financial market. Mobilization. 2. Funds determination. Along with determining the prices at which the financial instruments trade in the financial market, the required return out of the funds invested by the investor is also determined by participants in the financial market. 3. Liquidity. The liquidity function of the financial market provides an opportunity for the investors to sell their financial instruments at their fair value in the market at any time during the working hours of the market. 4. Risk sharing. With the help of the financial market, the risk transferred from the person who undertakes the investments to those who provide the funds those investments for making. 5. Easy access. The industries require the investors to raise funds and the investors require the industries to invest their money and earn the returns from them, so it is easy access. 6. Reduction in transaction costs. But the financial market helps to provide every type of information to the traders without the requirement of spending any money by them, hence reduces cost of transactions. 7. Capital formation. Financial market provide the channel through which the new investors' savings flow in the country, which aids in the country's capital formation. Classmate. Date. Financial instruments can be broadly classified into 702. Money market instrument. B. Capital market instrument. Meaning of financial instruments. Financial items or financial assets like shares, debentures, etc., dealt in a financial market are referred to as financial instruments. Money market instrument. Meaning of money market instrument. The most liquid short-term debt obligations that are traded in the money market are called money market instruments. The money market instruments are as follows. 1. Treasury bills, 7 bills. 2. Commercial papers. 3. Certificate of deposit. 4. Repo, reserve repo. 5. All money. 1. Treasury bills, T-bills. Treasury bills, one of the softest money market instruments. It is a promise to pay a said sum of money after a specific period. T-bills are the short-term securities that mature within 1 year, like 3 months, 6 months, a year maturity periods. Date. 2. Commercial papers. Commercial paper is a low-cost alternative to bank cans. It is a short-term unsecured promissory note issued by corporate and financial institutions at discounted value on face value. 3. Certificate of deposit. It is a promissory note issued by a bank in form of a certificate, entitling the bearer to receive interest. The term generally ranges from 3 months to 5 years. The returns on certificate of deposits are higher than T-bills BLC. It assumes higher level of risk. 4. Repo, reverse repo. Repurchase transactions, called PEPO or reverse repo, These transactions in which two parties agree to sell and repurchase the same security. They are usually used for overnight borrowing. These transactions can be done only BW parties approved by RB8. 5. Call money. Call money is mainly used by the banks to meet their temporary requirement of cash. They are repayable on demand and its maturity period varies in BLW 1 day to a fortnight. Call money notice money term money lent for 1 day lent for more than 1 day. Lent for 15 days or more. Classmate. Date. Page. Capital market instruments. Meaning of capital market instruments. Capital market instruments refers to which includes all orgs, institutions and instruments that provide long-term and medium-term funds. It does not include short-period institutions. 18 called capital market instruments. The capital market instruments are 1. Equity shares. 12. Preference shares. 3. Debentures, bonds. 4. ADR-IGOR. 5. Foreign currency convertible bonds B, FCCBS. 16. Term loans. 7. External commercial borrowings. 1. Equity shares. Equity shares, commonly referred to as ordinary share and also represents fractional ownership, which undertakes maximum entrepreneurial risk associated with a business venture. Holder is member of company and has voting rights. 2. Preference shares. It is similar to debentures. Because it carries fixed dividend, it is ranked higher than equity capital on the basis of claim and it does not have any voting rights. Preference shares are given first preference in sharing profits. Date page. 3. Debentures bonds. Debenture is a document evidencing the debt of an organization. It is issued by a company as a certificate of indebtedness and it usually indicates the date of redemption and also provides interest at specified date. 4. ADR, GDR. An American Depositary Receipt, Dr., or Global Depositary Receipt, GDR, is a simple way for investors to invest in companies whose shares are listed abroad. The ADR and/or GDR is essentially a certificate issued by a bank that gives the owner rights over a foreign share. 5. Term loan. Term loan is a method of debt financing by banks with maturity period over 1 year to about 10 years. It provides for a fixed and large amount of loan required for setting up a new unit of project. 6. External commercial borrowings. An external commercial borrowings, ECB, is an instrument used in India to facilitate the access to foreign money by Indian companies. ECBs include commercial bank loans, buyer's credit, and fixed-rate bonds, etc. Date, page. SEBT guidelines for listing of shares. For trading in the stock market, a company has to list its securities in the stock exchange. It means that the name of the company is WES registered in the stock exchange. And the company has to fulfill certain conditions according to Companies Act. The company has to offer its shares, debentures, to the public for subscription. Only then, the company has to offer will be allowed to list its security in stock exchange. Asterisk for listing share in the stock exchange, a company must have minimum of $5 crore as 7/8 equity capital and public. 60.1. Add 73 crores 18 offered to. Conditions for a listing. Shares of the company must be offered to the public through a prospectus. 2. The prospectus should clearly mention opening of subscription, receipt of application, etc. 3. The presence's capital structure of the company should be public interest in securities. 4. The minimum issued capital must be 23 crore, of which 75 crore, i.e., 60.6. General. Date. Page 5. A company with paid-up capital of more than 5 crore should get itself more than one stock exchange. Listed in 6. The auditor secretary of the company applying for listing should declare that certificates have been stamped, no transfer for 5 years. 7. Letter of allotment, letter of regret, and letter of rights shall be issued simultaneously. 18. The company will issue consolidation say renewal certificates for letter of allotment, transfer, etc., when required. 9. Closing the transfer books for the purpose of declaration and dividend. For this purpose, die notice should be given to stock exchange. Annual readum of the company to be filled soon after the annual general body meeting. Tate. Page. Guidelines on issue of commercial papers. Asterisk commercial paper is a low-cost alternative to bank loans. It is short-term, a promissory note issued by corporate unsecret in financial institutions at a discounted value face on volley. Asterisk they are usually issued with fixed maturity between 1 day to 270 days for financing of accounts receivables, inventories, and meeting short-term liabilities. Asterisk commercial papers are actively traded in the secondary market since they are issued in the form of promissory notes and are freely transferable in DEMOT form. Eligibility for issue of commercial papers. 1. The issuing firm should have a tangible net worth at least 34 crore balance sheet, as per the latest. 2. The firm should have working capital at least 74 crore. 3. The current ratio should be minimum 1 to 33 as per the latest balance sheet. 4. The firm should have minimum P2, a 2 rating co from CARE or any other credit rating agency. Page. The credit rating should not be more than 2 months old from the date of issue of the commercial paper. 6. The borrowing account of the firm is classified as standard assets by financing banking company. Conditions for issuing commercial papers in India. D. No commercial paper can be issued for a period less than 15 days from the date of its issue. 27. There is no grace period for payment of commercial papers. 3. The RBZ has increased the maturity period of the commercial papers from 6 months to 1 year from date of its issue. 4. Commercial papers can be issued to any person including individuals, banks, and other corporate bodies registered in India. 3. Commercial papers cannot be issued to non-resident Indians, NRIs. The financing banker shall correspondingly reduce the working capital limits of every firm issuing the commercial paper.